Welcome to Simply by Deal HQ. On this podcast, we engage thought leaders on topical issues around law and business in the most simplistic manner.
Welcome to episode 2, season 2 of Simply by Deal HQ. My name is Tosin Ajose, and on this episode, our conversation will be centered around the impact of policy, insecurity, market volatility, and investor confidence on foreign capital flows. No doubt that this is a key priority for the new administration in Nigeria, and therefore, we will be exploring its attempts to bolster capital flows into the country on the journey to achieving monetary and financial stability. We are very privileged to be joined by Dr. Kale, who is a partner and the chief economist at KPMG Nigeria. Prior to joining KPMG, Dr. Kale was chief executive and statistician general at the National Bureau of Statistics from 2011 to 2021, where he drove at a never-before-seen scale major reforms in our data production and dissemination process, leading to a decade of data assurance and credibility, which has been validated by stakeholders within and outside of Nigeria. Dr. Kale, I am really elated to have you on this episode of Simply, and I have no doubt that our listeners will also be very excited to hear your perspective on the impacts of government policy and market volatility on foreign capital flows, especially given your pedigree as the chief custodian of the nation's fiscal and monetary and economic data. So without wasting much time, permit me to quickly welcome you again and jump right into asking the questions.
Thank you for having me.
Thank you very much. So this opportunity. So we have always thought that Nigeria was a nation that could not be ignored in the play for global capital. But these assumptions in recent years have not only proven to be faulty, they have proven to be wrong. Therefore, in simple terms, what would you say is responsible for the consistent year-on-year decline in capital imports into Nigeria, despite the fact that we remain the single largest market in sub-Saharan Africa? But before you answer, I just want to put this in clear perspective for our listeners. Foreign capital dropped from $23.3 billion in 2019 to $9.66 billion in 2020. In 2021, there was a further decline to $6.7 billion. And last year, we recorded even a much further decline to $5.33 billion. So, Dr. Kale, what would you say is responsible for this consistent decline?
Okay, well, you're perfectly right. Nigeria's potential for strong economic growth is well recognized. The potential for also strong returns is also well recognized. So, it's a country where potential investors looking to come because they believe that there's a huge market. So there's a pay for huge returns. So in that regard, investors are always looking Nigeria's way when it comes to diversifying their sources of investment across the world. Unfortunately, due to long-standing issues related to the ease of doing business in Nigeria, we have been unable to attract more investment because at the end of the day, the capital goes where it is encouraged and where it's going to make returns. So the more difficult it is to set up a business in Nigeria, the higher the cost of operation, the harder the ease of doing business, whether it's in terms of enforcement of laws, whether it's in terms of getting some license or power, infrastructure, security, all those policies somersault. All these things is what the potential investor, long-term investor, is going to look at and then determine whether it wants to move its capital in Nigeria. Because at the end of the day, Nigeria is an potentially attractive market, but at the same time, there are countries that are also attractive. And even though the returns in Nigeria might be slightly more than others, the cost of operating in Nigeria might also be more than others. So at the end of the day, the net return that the investor will look at. So yes, you might get a large market in Nigeria compared to in Ghana, but the investor will say, well, after all my costs, I'll make 20% in Ghana and I'll make only 11% in Nigeria, even though Nigeria, I could have made 40%, but the cost wiped everything out. So all those things come into play. But in terms of the capital importation, as you know, capital importation has two major sides. There's the foreign portfolio investors. Those are the ones bringing their dollars, their pounds in for strictly just to buy bonds or to buy stocks in the Nigerian capital market. And then there's the FDI, that's the ones I was talking about, that bringing their money in for longer term investment. Now, the reason why it's been going down in the last 3 years, I think it starts first of all with the period of COVID. During the COVID, all the supply chain disruptions and everything that went on during that period, high inflation in developed countries. Now, when the reason why you bring money into Nigeria rather than investing in your country, say the US, is because the return on investment in Nigeria is much, much higher.
It's higher.
US. So if you are getting 1%, then if you are getting 1% and you can get 20% in Nigeria, you despite all the risk I mentioned, then you factor all that in and say, well, at the end of the day, I still get better returns in Nigeria. But as inflation started rising in those countries, their equivalent of the central bank started increasing interest rates. Now, by doing that, they are making their own country more attractive. So they are thinking, well, I can get 4% in my country rather than risk getting 20% in Nigeria. I might as well just, so the premium to move into a risky environment keeps getting reduced. So because of that, that's one of the reasons they will say, well, it's not worth the risk. Let me just it's better to get 4% guaranteed here than to risk getting 20% in a very risky environment. So that was part of it. People started taking their money out because the benefit of taking their money to a country like Nigeria was narrowing with the interest rates rising in their country. Some of them even used to borrow money to invest in Nigeria. So if interest rates are rising, again, you're borrowing money from your bank in the US to invest again in a risky environment. It's too risky, you don't want to do that. That's the first thing. The second aspect was, at the same time, the monetary policy, or should I say the FX management system in Nigeria was totally off. Now, it was not clear. That was ambiguous. It wasn't clear. It was not perceived as being fair. It was not perceived as being transparent. And then when an investor wants to bring his money in, they bring their money in. The CBN, in their opinion, was artificially holding the exchange rate at 430, 440. Now, the problem is that when they want to take their money out, if they cannot get their money out at 450, 460, they have to go to the black market and take it out by 600, 700. Now, whatever returns they make, whether it's in the capital market or in the investment, they're going to have to, they will wipe off just because they have to buy dollars.
So there was a significant wipe off on account of the unavailability of FX.
Yes, so there's no incentive to bring the money in because you are just not even sure how the system works, and in addition, you're not even sure if you have enough FX to take your money out. So you have a situation where the FX that was already in the system is struggling to come out. You're not going to bring in more money when you are hearing everybody, airlines saying they can't get their money, other investors that came in can't get their money. The new investors are not going to bring their money in that kind of environment. The CBN, rather than pursue a strategy of boost supply of FX, started managing demand, and that was the problem. If you are managing demand, you are discouraging people to bring their own money. That's one on the one. On the other hand, government-owned enterprises, export-oriented companies, they sell they export their goods, they get dollars. They don't want to bring it back into Nigeria because CBN will buy it for them at the official rate. They would rather keep the money offshore or bring it illegally to the back door to get 700. Now, because of that wide gap in between the official and parallel, you are now discouraging them for bringing the dollars in. So again, a lot less dollar supply comes with the economy. Home remittances that would ordinarily go to the official market will decide not to go to the official market because if my brother wants to say,
yes, exactly, send you $100, you want to go to the parallel market and get more.
Yes. So all those, because of this decision of the CBN managing of dollars, tightening the supply of dollars, and all the decisions about keeping dollars, everybody just so that over time the inflows of dollars or capital into the country, whether for portfolio investment, home remittances, whether for foreign direct, starts to dry up. So I think these are in my opinion, I think these are the things responsible for that precipitous decline in capital inflows from 2019. In fact, the value in 2019, if you do the calculations, is actually more than the 3 years that followed. So we got more
Absolutely.
in 2019 than we did for 2021-22.
In the combined, yes,
yes,
exactly. That is correct. Thank you very much, sir. Permit me to quickly take us back to May 29, 2023. So, as you know, very recently, Nigeria sworn in its new president. Following the elections that happened earlier in the year, President Bola Ahmed Tinubu took over the administration and the leadership of the country. And in less than a month of assuming office, his administration has taken some very critical policy directions regarding the removal of PMS subsidy and the unification of the parallel foreign exchange regime, which many consider as one of the quickest economic policy turnaround ever attempted by the Nigerian state. I think you also alluded to the challenges around the FX regime in your earlier conversation. So my question will be, in your opinion, how impactful have the steps that have been taken by the administration of President Bola Ahmed Tinubu been in restoring investor confidence, and what does it say about the general policy posture of the new administration?
Well, I think investor confidence as a result of the initiatives that the president has taken is high. It's not particularly surprising. These are the suggestions that domestic investors, domestic analysts, international investors have also several for the last 8 years been asking government to take. So the fact that they are taking it is not. I don't think it's particularly surprising that investors' confidence will increase since the administration seems to be doing exactly what both the domestic and international analysts, actors, investors have said they should do. So I think if you look at the various reports of the rating agencies, they cited the same thing: the unification of the FX, the need to be transparent the way the FX regime was operated. You see them also mentioning the impact of subsidies on government expenditure on the fiscal space, the mounting debt as a result of things like, of course, if you are now doing things in line with issues that they have flagged as challenges for their involvement in Nigeria, you expect them to view such steps by the president very favorably. And I think the fact that he's taking those steps really quickly, a lot quicker than virtually anybody would have expected, because ordinarily when a new administration comes in, you expect them to take some time to settle in and get their ministers in place, and the ministers have to study. But he didn't wait for any of that. He just went straight away with doing all these things. Then again, most of the things he did not necessarily need a minister to do, but historically in Nigeria, they set their ministers, they put their ministers in place to meet those policy changes, but he didn't do that. So I think a combination of taking the right decisions that people had already been talking about taking anyway, that he to take, as well as the speed in which he had done that. I would say cautious optimism. I think the investor public, the general public, the investor public, whether domestic or international, is cautiously optimistic. They're happy about what is going on, but at the same time, they're just waiting. It's not enough anyway to bring them in yet, but I think they see this as a sign of vision that has the willpower, that has the desire to take difficult reforms, because I don't think you will find many more reforms that will be more difficult than the first two that he has taken. So if you can take those first two, people will assume that every other reform should be easy to do, because this was probably arguably the toughest to do. And if you can get through that, the general public, investors will believe, well, this is a very good sign that all the different reforms, there are a lot of them, the different reform changes and so on that need to be done will be done. So I think so far, despite the short to medium term discomfort that we all feel, I think the general posture as far as the investor community is concerned is positive, cautious optimism. And I think the administration has demonstrated that they are willing to take those difficult decisions. What everybody is going to wait to see is whether or not they keep faith with this reform, because it's not the first time we've had administration that did some things when they came in the first year. Maybe not as fast, but they did some things that excited people. And after a while, everything just went back to the way it always has been. And I think that's why people are cautiously optimistic. Yes, you are moving in the right direction. Right. Let's hope this holds. Let's hope this holds. Let's hope the administration keeps faith with reforms and all these things that need to be done are done.
So everyone is looking to see whether this will consistently be the direction of the government over the long term of the administration. Very well. So one of the things that we typically like to do is to always link back to the regional market, because we like to pride ourselves as an Africa-focused transaction advisory firm. So I want to take it back to, Africa. So we know that the Africa Continental Free Trade Agreement has now entered its implementation phase. And it will be interesting to know your perspective on how you think that the attempt to collapse Africa into a single regional market will impact competition and capital flow into the individual states. So many have argued that there cannot emerge a single trade region in Africa if conversations around a single currency and a homogeneous monetary policy is not brought to mainstream. I just want to know what your take is on this. First, how does it impact competition, and what's your take around single currency and a single direction of monetary policy?
Well, let me just tackle the single currency. I don't believe a single currency it will be difficult to implement, and it will, especially because it will be disadvantageous to the bigger countries in the continent, the South Africas, the Egypt, and because the stronger your currency is less desirable for the stronger countries they block. So
Absolutely.
I think they're going to find a situation where they will resist that. I think what is easier to do will be to set up this single customs union. So you are focusing on things like on a movement of goods and people and business across the continent, and not really the currency. I think that's where the strength is, because it's going to create healthy competition. It's not even going to be necessarily competition across countries, because as a custom union treats all the countries in Africa like one. It's going to be a situation where you are joining the strengths of all the countries in the continent together, so that the country that has the competitive advantage producing one commodity is the one going to produce it for the rest of the continent, and maybe and then to export. So it creates a situation where if you are inefficient in producing something, you are in a particular country, you are forced to become more efficient. And if you are not able to produce something because you just don't have the comparative or competitive advantage to do it, you have to stop that production. It means that your resources will be devoted more to things, consolidated and devoted more to things that you have your strengths in. So I think it encourages efficiency, it encourages healthy competition, it encourages the faster development of the continent, it encourages the strengths. For example, if Nigeria's strengths are in technology, for example. Now we know that there are tech experts in many other countries on the continent, but they might not have the skill in their countries to actually do anything significant. Those tech experts can move to a Nigeria that is a tech leader, for example, and that helps to boost Nigeria's tech industry. So resources, human and capital, will move to where it is best used. So I think these are the advantages, in my opinion, of having this. I think it's a good thing for the continent. I think it's going to encourage greater intra-African trade, and it's going to encourage greater international trade coming from the continent.
International trade. So do you think that we are any closer to getting to a point where we can begin to see Africa as a single block in terms of international trade? Do we see that unification happening quickly, especially with the legacy of even getting to the point where, adoption of the agreement is as widespread as it is today? Does that signal that we are any closer to having that level of integration that will give a collective advantage, or will some people be left behind?
Well, I think we are, but I don't believe it's going to be very quick. I think that when you're trying to get over 50 countries to agree, they all have their laws, they have their different parliaments and things of that nature. It becomes very difficult to implement. They have their different business interests, and of course, business interests are going to lose out from the deal. Are going to try as much as possible to lobby to delay things. I think that we are moving closer to this. I don't think it's something that will happen pretty quickly. I think there's still a lot of hidden issues to make this all work. I think the countries are still very much the gap, disparity between the countries is still very, very wide, and so I think there's still going to be a lot more conversation, a lot more agreements. You have some countries that don't want to be left behind. There might be some concessions. The larger countries that will lose, there might be some concessions. I think that conversation is going to happen. But I think we're going to move in we are moving in that space, and I think it's going to take a bit long function. Even the European Union is not even yet fully functioning in that regard. It's functioning very well, but they still have every now and then they still have issues trying to. So I don't think that we're going to get to that situation very quickly in Africa. But I think we are moving closer and closer in that direction.
Yeah. So what I hear is that we are definitely converging, but the convergence will not happen overnight. It's a marathon, and we just keep getting closer.
Absolutely.
So one of the major issues that a lot of people would agree has plagued Nigeria as a sovereign is the dated perception of incessant policy and regulatory changes. And therefore, I just want to know from your perspective as a custodian of data for our national data for so many years, how serious is this in the metrics for assessing the political risk rating of a country? And how can Nigeria begin to develop stable monetary and fiscal policies that gives the global market for public and private capital sufficient sense of assurance? And this is important because you have spoken, very elaborately about the reason why we have seen, this consistent decline. And many of them have alluded to the fact that, policy instability and regulatory changes is very unattractive to capital. So how can what does the government need to start doing to begin to create a sense of relative stability in our policy direction that will give the global market the kind of assurance that it needs, especially at a time like this?
I think the issue of policy regulatory changes is not even just the policy changes, the regulatory changes, it's the speed in which they change. It's the frequency rather of those changes. I think any country, if it needs to change its policy or its direction because of some shock or because of a COVID or things of that nature, a global recession, and has to tweak things here and there, it's welcome. But I think it's very important that households, consumers, investors, whether domestic and global, understand the trajectory of the country. The objective of the government, the objective of the government is not to actually drive the economy, is to set the direction. And policy
Absolutely.
And regulations you create is actually set that direction. It's very difficult if an investor wants to come into Nigeria but is not sure if, for example, Dangote refinery. Imagine if in between, after when he had committed billions of dollars building the refinery, in between the construction of the refinery, there was a policy change that basically says, you know what, we're going to continue the subsidy and give even bigger subsidy that will make his business collapse. These are the kind of things that scare investors, that probably have to have gotten some clear commitments that this is not going to happen. And we have situations in Nigeria, all over Nigeria, all the states where this happens a lot. You have a governor come for 4 years or 8 years, he's done, somebody else comes in and completely tosses everything the previous guy has done, comes with something completely different, totally different direction. It's not inspiring as far as planning for investment is concerned. Even in our personal life, you can imagine if you had to be, those of us that have children, if you had to be changing your child's school every other week or every other month, it just doesn't work that way. So we should not operate a country that way. People need to be certain about a particular policy and direction of government so they can know exactly how to plan. I think one of the reasons why this has continued in Nigeria is because of that lack of appetite for proper long-term development planning. One of the things that sets us apart, or rather has put the countries that were around the same level, the Malaysia, the Indonesia, we were either above or around the same level in the early 1970s, but now they've gone way past us. And one of the major reasons is because they stuck with their we did not. I think by the 80s, we did away with when we saw oil, we did away with proper planning, and we now started doing things in a very haphazard, gut feeling type system. And that's not the if we want to get away, in my opinion, from these kinds of situations where a new administration comes in and just totally reverses the policies of the old one and then continues that way, I think we should go back to long-term development planning so that the country decides that this is where we want to go, these are the sectors we want to boost, and this is exactly how we're going to do it. And then, regardless of which administration comes in, federal or state, they are committed to following the same development plan for the next 30 years. I think if we get to a situation where our development plans are legally backed, so that a new person cannot come in and just start changing policies or changing disputes, then I think we'll probably develop a lot faster and we'll get a lot more people more comfortable in the way we run our affairs in the country.
Absolutely. I think I agree with that. Let's talk quickly about insecurity. This is definitely one of the other things that I believe you spoke about that has impaired and impacted, capital flow. So it's important that we touch on it. How does insecurity generally impact markets? Is there an actual direct correlation between market volatility and insecurity, or is it more attuned to the quality of leadership and economic policies? Also, can data analytics give us a clear and decisive insight to causative and curative factors for tackling insecurity in Nigeria? Is there a data play?
Okay, I think market volatility is both has security as well as leadership and economic policy perspective. The market reacts in a volatile way if you have an insecure environment. It also does that if you have unclear policies or you have poor leadership. So I don't think it's one or the other. I think market volatility is a function of all the things you mentioned and other things. I think there's a clear, and the impact of security is very clear on the economic environment. We all remember what has happened. One of the reasons why food inflation is very high is just as a result of insecurity, the inability, not that the inability of the farmers to go to their farms to produce the agricultural commodities that we consume, and even when they are able to do that, the challenge in transporting those commodities across the country shoots up inflation. And there is a correlation between all of these things. For example, I'll give an example with the Northeast. Before they became as bad as it is, while I was at the handling the Nigerian Statistical Office, we showed repeatedly through data worsening conditions in the Northeast. Virtually almost all the socio-economic indicators had been worsening for several years before that. And we are showing that, look, the way this is going, you are seeing poverty rising, unemployment rising, you are seeing health education health and education indicators worsening, security challenges worsening, infrastructure. So you are seeing all these worsening social and physical and economic indicators. Eventually, the security challenge that came out of that is not surprising. So if you have a situation where poverty is rising, unemployment is rising, a situation where people are less and less people are going to school, their health facilities are worsening, then you are breeding potential security concerns, because all these idle people that cannot find work, or are not fully engaged, or are even working but they don't have a living wage, are going to find they'll be easy targets for those that want to use them.
Absolutely.
So in that regard, yes, that's how your data can tell you, can inform you of potential problem coming. I mean, if you notice that unemployment, poverty is rising in a particular region, for example, you know that's going to feed into security eventually. Then you can go in that.
You must be paying attention to the potential security impacts of that.
Absolutely. If you feel that inflation is rising and it's rising so much faster than increase in people's wages, you know that eventually there will be some social unrest coming at a particular point. I give you an example of the COVID lockdown. Initially, everybody accepted that there was need for a lockdown, and government went to sleep. And after about a month, people started to react on the street because their incomes, their livelihood was affected. Now, if you are paying attention to data, data will tell you that, well, these guys, most of them live from day to day, from hand to mouth.
They
can't really afford to just be locked down in the house for more than a month, more than 2 months, and then you find a way to cushion the effects of that. That's exactly what you do in other countries. In the US, people were getting checks sent to their houses because they understood that they work hourly wages, so a lot of them get their money on a daily basis. If you keep them in the house, they can't go out, they can't feed, they can't buy food, they can't take care of their families. If you are paying attention to the data, it will tell you exactly how to react to any global shock, rather than just taking a decision, which we do in Nigeria, basically on gut feeling, on emotion, without looking at data. Data, I think, the objective of data is to tell you what the challenges are and to tell you how to fix it. So I think anytime we take decisions without looking at the data, we're just rolling the dice and hoping it works out. Sometimes it works out, other times it doesn't. And if it doesn't, the consequences can be very, very dire.
I'm so excited because for me, I mean, it's very comforting to know that we're not helpless. Many times we just need to go back and track the data and see how we got to where we are and how we can get out of it. That's really very comforting, Dr. Kale. So let's talk a little bit about technology and innovation. I know that in recent years, Nigeria can be said to have established itself as an investment destination for technology innovation and digital advancements within Africa. According to Nairametrics, funding raised by Nigerian tech startups in 2022 alone was estimated to about $1.3 billion US dollars. And data from the National Bureau of Statistics also noted that about 20.32% contribution to Nigeria's GDP in Q3 of 2023 came from the ICT sector. So my question would then be, in your opinion, what role does technology and digitization play in attracting capital inflow? And then just to connect that again, does the flow of capital to tech industry indicate an immunity of the sector from the economic realities that have bedeviled our real sector? Why are people still investing in technology in spite of all of these challenges? Is that sector insulated from all of these challenges we're talking about?
Well,
what's this data saying? Yes.
I think people understand that technology is the future, and regardless of what the challenges we're having, in fact, technology is probably the solution to fix many of the challenges we're also facing. So I think everybody understands that technology is the future. So the short-term challenges, medium-term challenges we have is not going to stop technology from growing. In other countries, technology is moving at a very, very fast pace. In Nigeria in particular, I always believe that the more challenges you need to fix, the faster your technology will grow, because that's exactly what technology is designed to do, to solve problems. And so the bigger the challenges you have in your environment, it's not surprising that you have a technology driven sector that seems to be doing very, very well, even though everything else is not, because that technology that is actually supposed to help to fix the other things that you're talking about. So not insulated per se, but the solution to those problems. And I think that's why it's booming in Nigeria as well. And I think we have an advantage of having a very young, dynamic, intelligent population. I mean, one half of the Nigerian population are young, and I think, and it's the younger generation to be more in tune with technology. So I think there's a natural fit in the Nigerian economy. I think that's another reason why it's doing very well in Nigeria. We know that technology is critical for is a critical tool for giving young people in Nigeria that sense of inclusion. The only other one that can compete favorably, I would think, is the entertainment sector. But apart from technology, apart from the entertainment sector, the only other real sector in Nigeria that really connects young people and makes them feel included in the Nigerian environment is technology. And it's also a good place to so whether it is expanding, investing in broadband infrastructure, whether it is most of the technology companies anyway in Nigeria are financial technology company, fintech company. The reason, because like I said, we have one of the challenges in that space is to expand the amount of Nigerians that have access to bank accounts and to expand electronic payment systems and so on. And that's exactly probably why most of the investments in tech in Nigeria is also fintech. Again, because there's a problem that needs to be filled. Banks don't have or don't want to spend the capital putting bank branches in all these rural areas, and then fintech will rescue, solve the problem without having to open up branches in every corner of every street. So I think a combination of that, the huge challenges that we have to fix in Nigeria, the limited capital in the environment, the fact that we have an advantage in terms of our population that are very, very much tied, young population rather, is very much tied to technology. I think all these things make technology in Nigeria boom despite the other sectors struggling. And again, I think we are also starting from a very low base. Also makes us grow even faster because we are starting from a lower base, unlike more advanced countries that are even growing in double digits. So you can imagine when you are growing even at a lower base, it helps you to outperform the entire economy.
Right, absolutely impressive. I mean, this just allows us to understand. I'm sure a lot of people have been able to relate. Okay, this is the reason why, we're finding that, in spite of everything, the technology sector still remains, hugely attractive for foreign capital, and that has not changed. So just quickly as we wrap up, I've thoroughly enjoyed my conversation with you. In your opinion, what is the one critical thing that the current administration needs to focus on in the first year of its administration that promises the biggest impact on repositioning Nigeria as Africa's investment hub?
Well, if the question is investment hub, I would say improve the ease of doing business. And just under that title, there are several things that need to be, whether it's harmonization of taxes and levies, whether it is fixing physical infrastructure, particular power-related challenges, and distribution networks, whether it is fixing security, even ensuring the sanctity of the law. I mean, and contracts. Like if and then the ability to get approvals, different kinds of approvals that I need for my business. So under ease of doing business, there are just so many things to unpack there. And if you say the one most important thing, if I was the president, to improve Nigeria's investment of what that gives us, we have the advantage, we have the population, we have the market, we have the talent. But where we have concern, where we have challenges is our cost of production. Our cost of production makes us is usually much higher than other African countries and other emerging economies, because the ease of doing business is just much higher than many other countries. So if we can fix the ease of doing business challenges, it will improve our rating. It will reduce cost of setting up and operating in Nigeria, and in the process, it will attract more foreign investors into the country. People will come and set up in Nigeria. We have the natural resources, we have the population, but the challenge is cost of operation. If we fix the ease of doing business, I think that will boost Nigeria's position as a major investment hub in the country.
Yes, thank you very much for making the time to join us today, Dr. Kale. It's been
thank you for having me. I thoroughly enjoyed myself.
42 minutes of very insightful conversation. And to you out there, thank you for being a fabulous audience. Remember, the conversation continues on our social media handles, and do remember to send us your comments and thoughts on today's episode. Thank you, and bye for now.
Thank you for listening. This podcast is brought to you by Deal HQ Partners. To find out more about our services, visit www.dealhqpartners.com. See you on the next episode.